out. Yesterday, you had M&M Finance, which did declare its numbers, and it was very disappointing. The profits were off by 18%, net interest income up by 20%. We will be, in fact, touching base with the management. The stock price is currently off by close to 3.7% as we speak. Remember, overall, the counter came under a fair bit of pressure, so let's garner more perspective then from Mr. Ramesh Iyer, who now joins in on the show. Thanks very much for being with us, Mr. Iyer. Now, to start off with the profits, that has been down by close to 18%. What really led to this downtick?
Yeah, if you kind of look at it, this has been a business which has its own cyclic impact, and we are pretty uniformly spread across the country. And historically in the past, we always had a third quarter improvement. And that's at the back of the fact that the harvest is good in the third quarter. The north and the western markets start showing a lot of improvements. But in this time, the real pressure point for us has been the southern market, where we have large exposures, and the market has not been doing too well in the last about 10-12 months time, and that's impacted the collection process. But also importantly, the harvest in south is only after 14th of January. So clearly one is seeing a positive trend in the fourth quarter coming from these markets, and also the two major markets of Madhya Pradesh and Maharashtra, where because of monsoon effect, the yields have been good, support price is good, but the benefit of cash flow is not come into the third quarter fully. It just started about middle of December or a little late than that, and we do expect the flow of cash flow will also happen into the fourth quarter. So our belief is that yes, the third quarter has been a little pressurized quarter in view of the market conditions and behavior. But I think overall sentiments are positive in the fourth quarter. The yields are good, support price is good, corrections seen already in the southern market. And we have prepared ourselves to take advantage of this changing scenario by opening up more branches, putting appropriate resources, broad-basing our legal system. So I think we know what's happened, we know what's happening in the fourth quarter, and we're getting ready to take benefit of it. And we don't expect that the fourth quarter would show this kind of pressure that we saw in the third quarter.
Mr. Iyer, good morning. Give us also a sense of your asset quality and what has led to the rise in the sharp rise in provisions on a year-on-year basis, and also if you could give us a breakup of your provisions.
See, clearly the gross NPLs have moved up from a 4.1 levels in December 12 to a 4.7 levels in December 13. And that increase is caused by, as I said, the exposure in the southern market and therefore delay in cash flows, and that's pushed up the NPLs to an extent. The delay in the cash flows coming in from Maharashtra and Madhya Pradesh has not witnessed the correction one would have expected to see in the third quarter. And fourthly, even though we are not a significant player, but we have an exposure to heavy commercial vehicle, and we said this even in the previous quarter, that as and when the customer is not able to service his loan and he wants to surrender the vehicle, as we have planned to go slow on that portfolio, we are willing to take back the vehicle and dispose them off, and whatever losses do come in gets accounted for. And therefore on the heavy commercial vehicle, we have taken some losses in the third quarter as well. But largely the increase in the NPLs which has happened in the southern market, where we expect corrections in the fourth quarter to an extent, as well as better cash flow from Madhya Pradesh and Maharashtra, would take us to a position of correction. But the gross NPLs have moved up from 4.1 last December to 4.7 this December.
Mr. Iyer, what was also worrying this quarter was your asset quality this time around, which deteriorated. Do you think that we can see your asset quality improving going forward, and are there any specific geographies where you are seeing stress coming from?
See, let's look at about 5 or 6 states. In fact, about a year or 16, 18 months back, it used to be UP where we had a lot of NPS coming in. That's got corrected. No sooner the sugarcane price was good, some economic activity did commence there, we are out of it. So these are businesses which are very dependent on the local activity, the yields of the crop, the support price, and therefore the cash flow. And historically, the last 20 years, we have seen it in different geographies in different forms. So it's not something that we have not witnessed in the past. It is just that the 4 south states together this time have gone a little slow in the last 12 months or so, and we do expect definitely from our side corrections happening out there. The second is they are all collateral based business. At the end of the day, we are only in vehicle financing and tractor financing, and therefore it's a decision of the organization that at what stage do you want to repossess the vehicle, when do you want to sell those vehicles and book those losses. If you see and the market is showing trends of improvement, we have taken a view to have a partnership approach, and we want to live with the customer in their difficult times, and we know that one cycle the whole thing will get corrected, and we had trends in the past of a similar nature. And therefore, while we are concerned, we are not overly worried about the situation which has happened in the third quarter. The efforts and the resources are being put on the ground to take benefit of it in the fourth quarter.
Mr. Iyer, also if you could give us a sense of the margins as well as what's the outlook on that front going ahead.
See, clearly, if you look at it, we are not under pressure on the net interest margin levels. Yes, the borrowing costs have not come down as we were expecting, but that be it, our lending rates protect that. So the net interest margin is not compressed on account of either borrowing cost increase or the lending rates inability to pass on. Again, the net interest margin is also an impact of a product mix change that sometimes happen, and it also an impact of when you have an NPL, your cash flows in the company is low, and therefore you borrow a little more to be in the business, and therefore the interest cost slightly goes up as compared to in the past. And therefore that again is a temporary phenomena which gets corrected as soon as your collections from the delinquent account starts coming in. So the margins are not under pressure. If you look at our growth, even in a depressed scenario in the third quarter, we have had a disbursement growth of 9%. On an overall year basis, we are maintaining a 14-15% growth in disbursement. Balance sheets have grown at 25%. The income is growing at 25%. It is just that one provisioning account which is there, higher provisions which has happened in the third quarter, and there are some one-time expenditure which we have incurred, like we had a spurt of advertisements in the third quarter. There's about 9 crore of one-time expenditure. That's not likely to repeat in the fourth quarter. We have broad-based our legal system, and therefore we incurred certain costs to set up those requirements in the third quarter. They are not repetitive in nature. We've opened about 60-70 branches, and there are some variable costs that comes in. The benefit of that will only start flowing in this quarter and going forward. So there are some actions which have been put in place, the cost of which has come into the third quarter, the benefits of which will flow only over a period of time. So we are very clear that which direction is this going, what is it that we require to do at the ground level, and the situation is not unusual while it's happened to us in this third quarter.
And finally, Mr. Iyer, in terms of your funds, of course, what's it looking like, and do you have any fundraising plans slated?
Not capital, because capital adequacy is appropriately at about 17-18 plus, and therefore there is no pressure on requirement of any fresh capital, so no fundraising on that front. But in as far as the interest cost is concerned, the market wants the interest to come down clearly because the sentiments are low, the auto sales are a little down, purely also on account of interest cost being high. So therefore the expectation would be the interest cost should come off. But we have not factoring anything in our workings to say is the interest going to come down and therefore is the margin going to improve. I think our answer is we are not factoring that.
All right, Mr. Iyer, we'd let you go on that note then. Thanks very much for, of course, joining in with more insight on what, of course, drove the numbers this quarter, and all the very best for the future quarters. And keep tracking that stock because you've got a heavy volume breakout as well coming into the stock. In fact, we're seeing the volumes which are at the highest level since the 30th of August, almost at the lowest point of the session today as well, or at a level of 244.2. Ashwini, just want to